If you felt like the market lost its mind this week, you're not wrong. In a matter of hours, roughly $600 billion evaporated from the S&P 500. Then, just as quickly, $650 billion came rushing back in, down 1%, up 1.1%, like nothing happened. The NASDAQ did the same thing. This wasn't normal volatility. This was a whipsaw. And when you see that kind of violent, directionless move, it's usually not about fundamentals. It's about liquidity. The $600 billion signal. Let's slow this down. When markets erase $600 billion in market cap intraday, then reverse it completely. That's not retail panic. That's forced deleveraging. That's hedge funds facing margin calls. That S positions being liquidated because they have to be, not because someone suddenly changed their outlook on earnings. When leverage unwinds, it doesn't discriminate. Funds sell what they can sell. And what sells fastest? Liquid assets, large cap stocks, gold, silver, anything with a deep order book. The repo window was tapped. Now here's where it gets interesting. Beneath the surface, the Federal Reserve's repo window was tapped for $11 billion. That may not sound massive in the context of trillion-dollar markets, but here's the key detail. It hadn't been used since January 2nd. And that date matters, because January 2nd was during the last major silver squeeze. When the repo window gets tapped, it means institutions need short-term liquidity. Fast. That's not a headline you see on financial TV, but it's a stress signal. Metals are not breaking. They being sold for liquidity. Now let S talk about gold and silver. Silver in the West is trading around $73. In Shanghai, 86. Futures, 88. That's a $13 premium between East and West. Gold is sitting around 48.80, down sharply from recent highs. And people are saying the bull market is over. But here's the problem with that conclusion. In a true fundamental breakdown, gold doesn't collapse at the same time as equities. In fact, gold typically rises when stocks weaken. But that's not what's happening. Because this isn't a normal correction, it's a liquidity event. The dollar as a wrecking ball. In a liquidity crisis, everything gets sold to raise dollars. Stocks fall, commodities fall, even safe havens fall. Why? Because the dollar becomes the wrecking ball. When leverage is unwinding, participants don't care what they're selling. They care about survival. If they're long tech and long gold and long silver all on borrowed money, and tech collapses, they don't wait to debate the fundamentals of silver. They sell what's liquid. They raise cash. They meet margin. That's the game. Kindleberger's crisis model. There's a classic framework for understanding this. Euphoria, peak, profit-taking, panic. At the panic stage, selling becomes indiscriminate. Fundamentals become irrelevant in the short term. Everything trades as one. That's what we're seeing. It's not about supply deficits. It's not about industrial demand. It's not about de-dollarization. It's about leverage coming out of the system. The defensive regime is here. Look at the macro signals. The dollar is strengthening. That tightens global liquidity. The VIX, the Volatility Index, surged 60% overnight to 115. That's higher than when silver hit $120. The options market is pricing chaos. At the same time, bond yields are falling. Money is rotating into treasuries. When you combine a rising dollar, spiking volatility, and falling yields, you're looking at a defensive regime. Historically, that combination precedes equity drawdowns, commodity weakness, and credit stress. But here's the distinction. That doesn't mean the long-term thesis is broken. It means liquidity is dominating price, for now. The silver technical battlefield. Let's get specific. Silver's key support zone is between $72.60 and $70. That's the line. That's where price recently bounced. And there's something important about the structure. On February 6th, the candle closed above the December 31st low. That's called a swing failure. And structurally, it's bullish. It suggests that sellers pushed price down, but failed to hold it there. Now, here's the tactical setup. If silver holds above that 72.60 to 70 zone, and we see a violent displacement move on high volume, the next targets are 75 and 77. But if we get a body close below that support zone, the door opens to 67, maybe even the February 6th wick low. This is not a guessing game. It's level-based. Respect the levels. CVOL is screaming turbulence. There's another signal that matters. Silver's CVOL, its implied volatility index, is at 115. That's extreme. But here's what CVOL tells you. Not direction, turbulence. The options market is pricing massive movement in the next 30 days, up or down. It's saying the storm isn't over. And in environments like this, you don't get smooth trends. You get violent swings. In part 2, we'll talk about the gold options whale, the documented manipulation history, the structural supply deficit, the real risk still on the table, and why forced selling often creates the exact conditions for the next explosive rally. because what's happening right now may look like a breakdown, but it may actually be the setup. So we've established something critical. This is a liquidity-driven deleveraging event, not a fundamental collapse. But now we need to look at what smart money is doing in the middle of this chaos, because while price is shaking people out, someone very large is quietly positioning for something much bigger. The gold options whale. In the gold options market, a massive position has appeared. A large investor has been buying December gold call spreads, not small trades, 15 to 20,000 contracts, even after gold fell below $5,000. Let that sink in. Gold drops hard, volatility spikes. Mainstream headlines say the bull market is over, and someone with very deep pockets is building a long-dated position for a violent move higher. Here's the part that makes it extraordinary. For those options to expire in the money, gold would need to triple from current levels. Triple? That's not a short-term scalp. That's a structural bet. Open interest on these contracts is around 11,000. That's not retail activity. That's institutional scale. Now, does this guarantee gold explodes higher? No, but it tells you something important. Not everyone believes this sell-off is the end. Some believe it's the setup. The manipulation context, documented, not theoretical. Now, let's address something uncomfortable but real. Precious metals markets have a documented history of manipulation. In 2020, JP Morgan paid $920 million to settle a federal case involving precious metals spoofing. 2 traders were later sent to prison in 2023. Now, this isn't conspiracy theory. It's settled federal case law, spoofing, layering orders, concentrated short positioning. These are facts. And when you look at CFTC positioning data today, you still see highly concentrated short exposure among a small number of players. That doesn't mean every move is manipulation, but it does mean price action can be tactical, especially during thin liquidity periods, especially when Shanghai is closed, especially when leverage is being unwound. Extreme fear is everywhere. Right now, sentiment is broken. Mainstream commentary is declaring the bull market finished after a 40% correction, 40% in silver. Historically, that kind of correction is not unusual inside a long-term bull cycle, but emotionally, it feels catastrophic. That's the nature of volatility. And here's a statistic that most people don't know. Only 0.03% of global wealth is allocated to silver. In 2011, that number was 0.06%. So despite the rally, silver is actually under-owned relative to past peaks. There is no mania in allocation terms, no broad retail euphoria, no global overweight. If anything, there's apathy. And apathy is not how bull markets end. The structural deficit hasn't changed. Now let's step back from price action. Silver is entering year 5 of a structural supply deficit, roughly 200 million ounces short per year. Industrial demand is relentless. Solar expansion, AI infrastructure, electronics, defense systems, 5G networks. These aren't shrinking sectors. They're growing. And silver is critical in all of them. That demand doesn't disappear because hedge funds get margin called. The bearish risks. Let's be honest. Now let's talk risk. Because ignoring risk is how traders get wiped out. Liquidity crises can last longer than expected. Paper markets can override physical shortages in the short term. The dollar could strengthen further. The VIX could remain elevated. The Fed repo window could see more stress. FOMC minutes or economic data this week could trigger another sell wave. And technically, if silver closes with a strong body below 72.60 to 70, we could see 67, maybe lower. That's not impossible. That's the reality of trading in turbulence. Even the CBOE spike could resolve without an explosive rally. Volatility can collapse just as violently as it expands. This is not a one-way bet. What's actually happening? So let's separate emotion from structure. What is happening? A deleveraging event, funds overextended, margin calls, dollar strength, forced selling, liquidity stress visible in the repo market, options pricing massive turbulence. That's what's happening. What is not happening? The structural bull case is not broken. The supply deficit is not gone. Industrial demand has not collapsed. De-dollarization has not reversed. Central bank buying has not stopped. The opportunity. Inside the chaos. Here's the paradox. Forced sellers create price dislocations. They push assets below equilibrium. They exaggerate moves. But when the selling exhausts, when the last margin call has been met, when liquidity stabilizes, the snapback can be violent. That's how markets work. Extreme fear creates extreme opportunity, but only for those who survive it. The line that matters. So here's the battlefield. $72.60 to $70 in silver. Above that level, the bullish structure remains intact. Below it, expect lower prices before the next leg. This is not emotional, it's technical. Respect the tape. Final mindset. This is financial warfare. not a calm, orderly market. Volatility is the price of admission. Physical holders are positioned for the long-term deficit. Traders must respect risk and survive the turbulence, because the same forces that create panic often create the next rally. The question isn't whether volatility exists. It does. The question is whether this is the end or simply the purge before the next expansion. And history suggests that when leverage clears, structure reasserts itself. Stay disciplined. Respect the levels. And remember, liquidity events feel like collapse right before they reverse.